a powerful lesson about how human behavior works. But it also explained to us why the big firms couldn't play that game. It is simply not a commercial proposition to get out of a bull market, because every now and then they run further and faster than you expected. Japan went on and on and on, way beyond people's expectations. 2000 beat the record. There's a lot of difference between 35 times earnings and 21, the previous record. So sometimes they break out to an astonishing degree. Now, the bad news is that changes nothing. They go back even more and longer, and they go back where they came from. And the higher they go, the harder and longer they fall. But it changes everything when you're there. When you're having a bubble, it's really advisable to have the bubble be in one focused area. In 2000, for example, it was US growth stocks. It was not global. And real estate was really cheap, as in cheaper than the cost of building the building you could buy real estate for. The bonds were really cheap, and inflation-protected bonds had just come out, and they yielded 4.2%, 4.3%. I mean, can you believe it? Real return guaranteed against inflation. Even within the market, the value stocks were not too bad and the small stocks were not too bad. And small value was actually cheap enough that when the S&P had gone down 50%, it hadn't gone down at all. It was, I think, +3. I mean, amazing. And the REITs, all of the real estate, they were up 30% as the S&P hit -50. That was a bubble that was paradise for an asset allocator because there were so many alternatives. What you want to avoid is what Japan did in '89. Japan had the biggest bubble in history, I believe, bigger than the South Sea bubble, and that was in land and real estate. And the old story, the land under the Emperor's Palace was worth more than the whole state of California. We spent 2 days actually asking and digging, and it literally was. First of all, it's a big palace with great palace grounds. And secondly, downtown Tokyo, all around it, was selling for, 4, 5, 6 times downtown Manhattan. And the numbers worked out. Just amazing. Simultaneously, they had the biggest equity bubble of any important market. There are some flaky, tiny markets that don't count. But of any major market, that's the biggest bubble of all time. At the time, we were told it had gone 65 times earnings. There's always historical revisionism in the data, so you have to be a little careful. But at the time, it was clear, everybody agreed, 65 times earnings, which is pretty remarkable. And it had never sold at over 25 times before. So that's the thing that makes every value manager wake up sweating in the middle of the night, is Japanese stocks. Anyway, they managed to do both of these at the same time. And 31 years later, the land is not back, real estate's not back, and stocks are not back to where they were. This was a loss of perceived wealth so profound that you have to congratulate the Japanese for not going into a depression. And people talk about a lost decade, but that was a lost decade where they actually inched forward. They actually did not go even backwards for the decade. When you're taking that kind of loss of wealth, you're in trouble. Now, in the so-called great financial crash, which irritates me as a title because I think it was a housing bust, the housing market had this perfect 3 sigma, 1 in 100-year outlier bubble. It had been very, very stable historically. So to get to that level, it only had to go up only, he says, about 40% or so in 2 to 3 years, which it did. And then it gave it all back. But the trouble with 2007 housing bubble is it took the stock market with it. The stock market was not sensationally overpriced, but it was a big overpriced bull market. It was not in itself a bubble. The housing market was a bubble, a beautiful, magnificent bubble. And if you look at it, it's perfectly round. It goes up for 3 years. It goes down for 3 years, exactly the same speed. And it goes all the way back where it came from. And the housing bubble inflicted about $10 trillion of loss of perceived value. So 1 minute you thought your house was worth 400,000. 3 years later, you were told it was worth 550,000. 3 years later, you were told it was 400,000. And 2 years after that, 350,000. So you had lost an enormous asset. And housing markets are much more dangerous because more people own them. The middle class in particular that owns very little stock owns a lot of housing. And it really, when you lose that value, you skip the trip to Portugal and you realize you can't send your second son to private school. And it really flows through the system. Don't do it. So what do we have this time? We have, of the 4 major asset classes on the planet, We have 3.5 in bubble land. We have, Jim Grant would say, the most overpriced bond market and the lowest rates in the history of man that go back 4,000 years. There was never a time when so much had a negative return where you pay the government to take your money. So that's number one. Number two, we're a contender for the highest priced US equity market in history. I would say a majority of bubble experts think this is now slightly higher than 2000, which was epic. And some people do not, but at least we can all agree it's a contender. And then we have real estate. And real estate was kind of off screen until a few minutes ago. And suddenly, on some of the databases, it has risen 20% in the last 12 months. Schiller's series, a little more conservative, lags quite a bit. I think it's only up 13, but the other series, perfectly seriously done, up 20 is the sharpest rise, sharper than the 70s with inflation and sharper than the housing bubble of 2005. And what that means is metric we hero worship is multiple of family income. How much does the median house, the one in the middle, how many multiples of the median family income is it? It's a nice, stable, fair metric. It used to be in America that we'd sell at 3 times family income. And in the bubble, we kind of went to 4.5 or so and then back. And we are now at the multiple of family income that we were in '06, the very peak of the housing bubble. We're back. Now, the rates are very low, so all being well, you can, quote, afford it. What you can't afford to do, if you're a beginner, is buy it in the first place. How painful for most people high asset prices are. They're kind of fun when you own them. They're great for retirees who have nothing to do but liquidate their pile of assets. But for people who don't have it, and for society in general, it's a disaster. Because what has happened over the last 25 years is that the yield on assets has dropped as the price rose. And at 6%, you can reinvest and double your money in 12 years. And at 3, it takes 24 years. So in 48 years, you have a quarter of the wealth, ignoring taxes for a second, a quarter of the wealth that you would have had in the world on average of the 20th century. This is terrible. And the same with a house, you're getting half the house that you used to get for your income. It's a disaster for people who don't have assets. And the whole society is compounding its wealth much more slowly. It's such a simple arithmetic point, but nobody seems to get it. It is slowing our wealth creation down and giving us the illusion that we're all getting rich. And of course, if you have a house, you know that the house hasn't changed. House was the same house at 300,000 as it was at 450 and back to 300,000. It's the same darned house. It doesn't hold off the rain any better in a housing bubble like today. It's the same with stocks, by the way. They're the same old stocks. Only in stocks, you get the fantasy of pretending that somehow their earnings have gone stratospheric. And you can expand the storytelling to fit the available price. And that's why bubbles in the stock market are so dangerous. But when you look back, you find there was no dramatic shift in long-term earning power in 2000. It was just a game we all play. There wasn't even in Japan. There was a fairly modest upswing in profit margins. And profit margins are, as I like to say, the most provably mean reverting series in economics. So if you pay up for rising profit margins, that is absolutely the wrong thing to do. You should pay up for crushed profit margins because they always bounce. You should pay down for heroic profit margins because they always move downwards. Anyway, so here we are. We have the trifecta. First time in American history, the real estate market, the bond market, and the stock market. And then coming up on the rails, as they say, are commodities. If you take the Goldman Sachs index for non-energy, they have a ludicrous total index. It's so dominated by oil that when they break out oil and non-oil and the total index, you can't tell the difference really between the total index and the energy part. But if you look at the non-energy part, which is all the metals, all the critically important foods, plus 1 or 2 other things like cotton, it's back to the all-time high of 2011. It's back to that epic move in commodities. I mean, who knew that? The broad base of commodities, a lot of them that count, are back to the all-time high. And the UN Global Index of Food Prices is not far off its 2011 high. And then there's a more complicated story of energy, because energy in terms of fossil fuels is in the end game. The paradox, or the slight irony here, I suppose, is in the stock market, where it really is focused most on the US. And although the developed countries are, quote, overpriced, it's fairly business as usual. And there are some countries, the UK, for example, and some would argue Japan, are not particularly expensive. And emerging markets seem to be perfectly ordinary, which means against the bubble US, they're one of the 2 or 3 lowest relative points in history. And from those other points, they have done very, very well indeed. As recently as 2008, emerging markets sold at a PE premium to the S&P, and now it sells at half. And that's a pretty decent discount.